How you doing, Professor?
Hello, how are you?
Doing well, thank you.
Yeah. Good. Okay. Hey guys.
Hi, Professor.
How are you guys doing? How goes life?
Can't complain.
There's not much going on.
There's I don't know how many of you have seen The Sopranos. There's a line from that show where someone asks, how's it going? And the guy goes, I would complain, but who'd listen? So that's how I feel about this. So anyway. Okay, so we have 4. Maybe wait a couple more minutes before we get started. So any questions while we wait for,
Yes, sir.
yeah?
If we're trying to calculate IRR,
Mhm.
how do we do that? Do we guess and check?
Guess and check is one way. Financial calculators would be able to calculate IRR. You can put it in an Excel sheet, the cash flows in an Excel sheet, and there's a formula to get the IRR. So by hand, you can only calculate really, if you're good at doing algebra, maybe like a 3-period model, because a cubic equation can be solved by hand still. Like anything, any higher order polynomial than that, I would just guess and check is one method, obviously. But
So like if it's close, so we do guess and check and we get it close, that's okay then? Obviously not the exact percentage.
Mhm.
I even tried to do it on like, I was like trying to like code it a way that worked and it still wouldn't even spit it out because it was too complicated, the homework problem, like wouldn't even load. So I don't know how to use Excel, so I didn't know how to do that. But I guess I can do guess and check.
yeah, even Excel, if you look at the back end of how they do the IRR calculation, it basically is doing a guess and check. So it's doing a grid search for the solution. So
And I
it's
guess
it's checking for multiple values and checking the difference and then revising the new guess and keeps going.
would that be the same thing for if we want to find when two different cash flow streams would be equal to each other, also guess and check?
NPV is straightforward, much more straightforward. So if you want, like, okay, so I can just pull up. So if you had to do NPV, you just needed the cash flow stream, the discount rate, and the timing on the cash flow. This you don't really, there's no reason to guess and check here. Right? You just,
But
you do this. With the
yeah, how do we find it? How do we find R if we don't?
R here is going to be basically your discount rate, right? So,
Yeah, so and that's we do guess and check, right?
so when you're calculating the IRR, you're calculating for R because you know NPV in a certain sense. If the price in the market, you know this you can discover inside the market. For a tradable asset, the market price is known. Assuming that you can project cash flows, right? Assuming that you know today's cash flow and can assume some growth rate G on the cash flow, you can predict both of these things. Now, then you're just setting up so that you can calculate for R here. Right? That's the difference between IRR and going the NPV route. On the NPV route, you're assuming that you know the discount rate, the relevant discount rate applied to the cash flow. So you make a informed assumption about what that discount rate should be. On the IRR, you're looking at what is the minimum rate that I need to earn for this transaction to break even. Right? If I pay this much to own these cash flows, what is the discount rate, implicit discount rate being applied so I can get to break even on that investment?
But we just put in 0 for the NPV to find the IRR, and then we do guess and check that way.
Yeah.
So then let's say instead of doing the IRR, let's say I'm saying we have 2 different cash flows. So instead of setting the cash flows with the discount rate equal to NPV, I would just set it equal to another set of cash flows, and then question find R where they're equal.
Yeah, so you could do the same thing and calculate 2 different IRRs for one project and the other project. And then you can compare based on the IRRs, which is preferable, right? And the other way to do this is to calculate the NPV for the first project, NPV for the second project, and compare between these 2. But you can't compare the IRR against the NPV for the second project.
But I think one of the questions I think on the homework was like find the point when the 2 they like crisscross. So not like which one's preferable, but like what's that point? Meaning at what discount rate? So at that, then would we just set them equal to each other and then find R? And then could we use the guess and check method as well, or should we just, or would algebra work easier for that one?
Yeah, you could do guess and check, or if it's a 2-period model, I forget what the question. Let me know what the question is. Let me take a look at it so I can give you a more detailed answer. I don't remember off the top of my head.
In chapter 6.
So, chapter 6, question what?
think it's 8.
8. Okay. Let me take a look at it as give you a more detailed answer, because let me just take a.
The last part, it says 8.
Yep. Okay. Sounds good. Perfect.
Yeah, but for net present value and IRR, you
Mhm.
can just, most TI-84s have that programmed into the calculator.
Mhm.
So you can just put it in, and there's a link online of how to do it. Just go to like TI-84, and it
Mhm.
will show you how to do net present values. It's super easy. You just like put a bracket, put in
Yeah.
the initial outlay, put in the cash flows, and it'll spit out the net present value. And
Yep.
the same thing with the IRR.
Yep, it does. So any financial calculator, it's pre-programmed into it. So you can just do that as well. Yeah. But I mean, if you want to understand what the backend is, the backend is basically they're doing a guess and check, a close approximation of the answer. Like they basically set up a grid around the right answer and then check their way through the grid to get to the right answer, the answer which generates the least amount of error. So, yeah. All right. Okay, I'll take a look at the question and send you an email, or maybe I'll just post an announcement on Canvas. Everyone can take a look. So it's not a issue. All right. Anything else before we get started? Okay. All right. So this is where I'm going to switch gears. This is where we go into asset pricing, right? This is where we begin talking about modern portfolio theory. How do we assemble portfolios? What is the relevant criteria? What is the problem that we're trying to solve? And all of those things, right? So it's my favorite section of the course, to be honest, because it's also quite interesting. Like the first section and the last section of the course is where I really enjoy teaching the material, because there's a lot of moments where you go, oh yeah, now the world makes a little bit more sense. I hope that this is one of those situations where you look at what modern portfolio theory has to do, and it's very simple in its setup, and it's very elegant in the kind of results it throws out. Okay. So before we get into CAPM itself, which is the workhorse model for doing asset pricing in general, we'll talk about the basics. We'll talk about mean variance portfolio analysis. This is basically foundational for modern MPT, a modern portfolio theory. This is where everything begins. And the setup of the problem is fairly straightforward, right? So we start from very simple priors, right? Suppose you have $1 to invest, right? So you start with $1 and you want to decide, how do I invest this dollar? And suppose you have only 2 risky assets, right? We start with the 2 risky assets case because this is the simplest case, because you need at least, if there's only 1 risky asset, there's no trade-off. You take the dollar, put in the risky asset, whatever is the return, that's basically it. 2 risky assets builds in the trade-off. That's what makes it a portfolio selection problem, right? So there is 2 risky assets, both of them have risk. So asset 1 and asset 2. Okay. So asset 1 will return R1, asset 2 will return R2. Okay. So that's the basic setup. Okay. So if I think about R1, it's risky because R1 is going to be a random variable. Right? This return here is a random variable, which means that I can get different returns by investing in this asset with different probabilities. I'll never get the sure return R1. It'll be a random variable. Okay. Same thing with R2. It's a random variable. It can generate multiple different kinds of returns with different probabilities. So that's where the risky part of it comes from, the understanding that the returns are random variables. Okay. All right. So the first thing in this is that we assume that the expected return on the assets are known. We assume that the variances on the assets are known. And we assume that we know the covariance between the assets. We'll get into each of this in a second. Yes, no. Okay. Right. So that's foundational assumptions that we make about what we know about these assets, that we can know the expected return, we can know the variance and we know the covariance between the two assets. So in a certain sense, this assumption is foundational, because if you think about what the timeline looks like, this is you today trying to make an investment decision, right? You're sitting here today trying to make an investment decision. If you think about how information is distributed, all the information is here. The only way you can get information is by looking at history, at the historical data. All the information is in the past, all the risk is in the future, right? Because the future is uncertain. The past is not. The past, you know exactly what happened. You have historical data, historical prices, you know everything there is to know about the past. You can get as much information as you want about the past, but the future is where the risk, all the risk lies, right? So in a certain sense, what portfolio theory assumes on its basis is that we can use this past information and make informed decisions about the future. So how are these expected returns on these assets known? The expected returns are known by looking into the past, right? In the past, this asset on average returned this much return, right? So if I look at a particular stock, I can only look at its past performance, and I know what the average return over the past 5, 10, 15, 20 years, depends on the horizon you're looking at. I can look into the past and look at the volatility. I can look at the variance in the returns from on a year-to-year basis. I can look into the past and establish a covariance between two different kinds of assets. All of this that I assume is known is going to be based on historical information. I'm going to use that as the basis to try to invest into the future, right? So therein, there is a bit of a quandary. In a certain sense, I'm making a decision looking forward, but I have to rely on looking back to come up with that decision, right? So in a certain sense, you have to be kind of clever about how you use this information. The finer your predictions are on the future, the finer the projections are, the better the analysis is going to get, right? All right. So, okay, let's assume that we know this. We can always get it from historical data. Then the portfolio selection problem is very straightforward, right? So if I think about what the portfolio selection problem is, I have two assets, I have $1, I have two assets. Asset one has an expected return of ER1, asset two has an expected return of ER2. I know the variance or the standard deviation for this asset. I know the variance or the standard deviation for this asset, and I know the covariance between these two assets. Okay. Now, the portfolio selection problem basically means, okay, so I have this $. How do I take this
Professor,
$?
it's possible that I missed this. Why is the covariance significant? What does that mean?
Yeah, I'll get into it in a second, but the covariance essentially is significant in an intuitive sense. If you think about two assets, you want to know how the performance of one might influence the performance of the other, right? So if you think about Apple and Microsoft, they're two companies which are in the same space, more or less. They're competing within the same space, right? So if there isn't, they're related in one sense. If Apple's fortunes go up, Microsoft's fortunes might be influenced by the fact that Apple's stock is going up, or it might come down, it might go up. There might be interrelations between the two assets. They're not independent of each other. The returns are dependent on each other. That's what the covariance is trying to capture, the relative movements in each of these assets, which is owed to the movement in the other one, right? So that's the reason why we need the covariance. So in an intuitive sense, that's what the covariance is measuring. The covariance is trying to measure the interrelationship between the two assets. Okay. Right. Okay. So the portfolio selection problem then is fairly straightforward. The portfolio selection problem says, how do I take this $1 and distribute it between the two assets? Okay. How do I take this dollar and distribute it? So I choose a weight W1 on asset one. I choose the proportion of that dollar I put into asset one. The remainder goes into asset two. Okay. So that's basically it. That's the portfolio selection problem. I have $1 to invest. I have two assets to choose from. My entire selection problem is on choosing these weights. If I choose W1 to be 50 cents, W2 is automatically 50 cents. If I choose W1 to be 99 cents, W2 is automatically 1 cent. It's about taking my capital and allocating it between the two assets, two risky assets I have available, right? Okay. So in the first sense, the portfolio selection problem is about choosing portfolio weights, right? So choose weights W1 and W2, right? You end up choosing these weights. This is the percentage of your portfolio which is invested in either asset. And the binding constraint on this is that the sum of the weights should be equal to 1. Okay? We can't ever have a situation where the sum of weights is not equal to 1, because, you know, if this is 50, if I add both of those, you have that between the two weights, it has to add up to the whole in the end. Right? So in a certain sense, this you could think of as the budget constraint on the selection problem. Okay. So you constrain that the sum of the weights on all the assets in your portfolio need to sum to 100%. Right? That's basically you're allocating all of your money between all the different assets you have available. Okay. All right. So far, so good. Now, what is the criteria? Right? What is the criteria on which I make this choice? What am I trying to optimize for? So that takes us into this notion of the portfolio return. Okay. So if I think about the expected return on the portfolio that I form using these two assets, it'll be W1 times the expected return I get on the first asset plus 1 minus W1 times the expected return I get on the second asset. Right? It's just a weighted average of these two assets, right? So, you know, in a simple sense, if the expected return on the first asset is 10%, and if the expected return on the second asset is 5%, and if I choose a weight of half on the first asset, so I take half my money and put it in asset 1, and the rest, the other half is put on asset 2. On average, I would get 5% return from here, and I would get 2.5% return from here. So on average, my portfolio will return 7.5%. The expected return on the portfolio then would be about 7.5%. Right. Make sense? So I have a couple of notes here on this expected return. Oh boy. Okay. Just give me a second. Disconnected, probably. Okay. So I have a couple of notes here on the portfolio return itself. Notes on W1 and W2. Okay. So there's two cases that we generally consider. The first case is what we call no short selling. If you think about what short selling is, the mathematical representation of it is that WI, the weight on any asset in your portfolio, is strictly greater than or equal to 0 for all I. So you can never have negative weights. I'll get into what it means to have negative weights in a second, but when we consider the first simple case, you can't have ever a negative weight, right? Either you put no weight on you don't take any of your money and allocate it to one asset, in which case the weight on that asset would be 0, or it would be something positive, right? You can either stay out of that asset completely, or you can put some positive proportion of your wealth in that asset. Okay, that's basically what no short selling allows for. So if you think about what the story here is, that okay, if there is no short selling, then the maximum expected return on the portfolio, RP here now represents the expected return on the portfolio, is going to be the maximum of one of these individual returns. So if you have n different assets to choose from, under conditions of where there's no short selling allowed, it makes sense, right? So the maximum return, if you're after the maximum expected return for your portfolio, the best you can do, so I should say it's less than or equal to, the best you can do is to choose the asset with the highest return, put 100% weight on it, and then you're done, right? If you have 5 different assets to choose from, one asset returns 10%, the second returns 20, the third returns 30, 40, 50, the best you can do with your portfolio, the maximum return that you can get out of your portfolio is going to take all of your money, put it in the asset which has the highest expected return of 50%, and you're limited by that. Okay. So when we don't have short selling, this is the condition that constrains how high returns can get in the portfolio. You can't get anything more than what the asset with the highest expected return can yield, right? You can't get anything past that. Okay. All right. Any questions on that? That's kind of straightforward, I think, hopefully. Okay. However, if I go into case 2, where I allow for short selling, then the key result that comes out of it is that any expected return on the portfolio is possible. Just by combining 2 risky assets, you can generate any expected return that you want to imagine. You want 100% return, we can generate it. You want a 500% return, we can generate it. You want a 2000% return on the portfolio in expected return terms, we can generate it just using 2 risky assets, right? So the intuitive understanding is that short selling in a certain sense allows for debt, right? So I don't know why it's behaving this way today. Okay, just give me a quick second. All right. So when we don't have short selling, the maximum return on the portfolio, the maximum expected return on the portfolio is constrained by the asset with the highest expected return. So you take all of your money, put it there, and that's best you can. But if you allow for short selling, then you can generate any expected return on the portfolio that you want by choosing the appropriate weighting scheme, right? So in a certain sense, what short selling allows for us to do is to use debt or leverage. If you're allowed to lever up or use debt as part of the portfolio selection problem, then you can generate any expected return that you want, right? So as an example of this, I think this is a powerful idea to see, especially if you don't have like a deep enough, like even a passing understanding of the financial markets where what short selling really means, you can see how this goes into action, right? Suppose we have 2 assets, the expected return on the first asset is 5%, and the expected return on the second asset is 10%. Yeah. So that's basically what we have, right? So I have only 2 assets to choose from. One will generate 5% on average, the other will generate a 10% return on average. So if I form a portfolio using these 2 risky assets, then the expected return on the portfolio is going to be the weight I put on the first asset times the expected return on the first asset plus 1 minus W1 times the expected return on the second asset, right? So that's basically what the expected return on the portfolio will be by combining these 2 assets in these proportions, where W1 of my proportion of my wealth is invested in asset 1, the rest goes into asset 2. Okay. So this is basically W1 times 0.05 plus 1 minus W1 times 0.1. Right? So I can write this as W1 times 0.05 plus 0.1 minus 0.1 W1, which is the same as 0.1 minus 0.05 W1. Okay. So the expected return on the portfolio as a function of W1 is basically this. So if I didn't allow for short selling, then W1 is constrained to be greater than or equal to 0, right? If I don't allow for short selling, then W1 has to be greater than or equal to 0. Then the maximum expected return on the portfolio I can generate is by setting W1 equal to 0, in which case I would have a 10% expected return, which is a basic way of saying don't invest anything in asset 1, invest all of it. W2 is 1, so W1 is 0 indicates that W2 is 1. Take all of your money and invest it in asset 2, and that will generate the highest possible return of 10%. Okay, that's all you can do in the case where there's no short selling. Okay? But if I allow for short selling, in the case that I do actually allow for short selling, suppose somebody comes up to me and says, I want you to double my money. I'll give you $1, I want $2 back, right? So suppose I want the expected return on the portfolio to be 100%. Right? That's basically the return that they want. On the average return on the portfolio, they want it set up so that they can double their money. Okay. Then it's a trivial problem, right? So, okay, so you want an expected return of 100%, which is 1, right? So the expected return on the portfolio is given by 0.10 minus 0.05 times W1. So if you want this to be 1, I set that equal to 1. Now this is 0.10 minus 0.05 times W1, which indicates that W1 should be 0.90 over 0.05, or this should be 18, or negative 18, I should say. Sorry, should be negative 18. Let me just make sure that I write it properly. So this here tells me that the portfolio weight on the first asset should be negative 18. Okay. So based on the budget constraint, immediately W2 is 1 minus W1, which is 1 minus negative 18, so 19. Right? So if I want to double my money, then the portfolio weight should be, on the first asset, it needs to have a weight of negative 18. On the second asset, it needs to have a weight of positive 19. If I choose my weights this way, then I'm able to generate a return of 100% on the portfolio. Right? So just using two risky assets, I can manufacture any return that you want. And those two assets themselves don't need to have very high returns. They can have any kind of non-zero return, and that's simply enough to generate a portfolio return of any size that you would like if you allow for short selling. Short selling basically means that we allow for situations where the portfolio weight can be negative. Okay. I'll get into what it means for the portfolio weight to be negative, but for now I just want to motivate that theoretically it's possible in conditions of short selling to generate any astronomical return you want, expected return on the portfolio that you would like. Right?
This is assuming though that you can take on as much debt as you want.
Mm-hmm.
Okay.
That's what short selling basically means. Right?
Yeah, but
So,
usually isn't there some type of like not in this case, but isn't there usually some type of agreement to like some maximum amount of like debt you can take on?
so in practice, how you would do this is that you would basically trade on a margin account, right? You would go to your brokerage and trade on a margin. Depending on how much wealth you have, the margins can be fairly high, so you can lever up quite a bit. But there are margin requirements that you are required to post collateral to cover the margin in case of, if there's a margin call, you need to keep posting collateral so that in the case of default, the lender has some recourse, some collateral. So usually it's securitized against the assets inside the portfolio itself. The assets that are unlevered that you already own inside the portfolio, those are pledged as collateral. But if there's a shortfall in the market value of those assets, then you have to put in additional money that you bring into the account so that you can maintain the margin requirement, right? So yeah, in practice, there are limits, but now we are just doing theoretical asset pricing for now. But for most retail investors, mostly the margin limits are not binding unless you're trying to lever up into some crazy situation.
When you just, Professor, one question.
Mm-hmm.
short sell, again, this is more of a practical question than a theoretical question.
Mhm.
When you short sell and you take on that debt, how much time do you have to like pay it back? Does that like depend on the brokerage firm or like
It depends. It depends on the short contract itself. It depends. The short contract specifies what is the delivery date. Okay, so if you think about what, okay, let me just talk about that for a second. So if you think about what short selling is in very simple terms. Okay. So suppose you want to short, let's say Apple stock. You want to take a short position in Apple stock. In practice, how you would go about this is in step one, you would borrow. Let's say you borrow, your friend owns 100 shares of Apple and you borrow 100 shares and suppose the price is $200 per share. I'm just making up these numbers for now, just to illustrate the point. Right? So the current market price of this Apple stock is $200 per share. That's what it's trading at. And you borrow that from your friend who owns Apple stock, who owns these 100 shares. That's what you would do first. Okay? The second thing that you would do is that sell 100 shares of Apple at the current market price. And this would net you, so the proceeds from the short sale, as we call this, proceeds from the short sale are 100 shares times $200 per share. Okay, so this will give you 20,000. Okay, so you have 20. Okay, 20,000. So you have $20 now in your account, right? You sold the shares, you have $20 of cash in your account. Okay. So what you do with this 20,000 is that you could sit on it. You could do nothing with it. Generally, you want to take that and invest it elsewhere. Let's say that's what it is. But suppose you don't do anything with it. You put it in your bank account and sit on it, sleep on it. Okay. What you're betting here is that when you're going to do a short sell, you're predicting that the price will fall. The price of this is an overvalued stock, and you think that the price is going to fall, right? So in the third step, suppose the price falls to, suppose you're right? Suppose you're right, and the price of Apple actually falls to $150 per share. Okay. Now, what you would do at this point is that you might want to cover the short position here. This is a judgment call. Where you cover the short is a judgment call. It is based on two constraints. What is the timing? So if your friend says, I'll lend it to you for a month and I need it back at the start of the next month, you have to cover the short before that, right? Well, you don't care what the price is. You need to deliver those 100 shares back to your friend at the start of the next month. So it depends on the length of the short contract. But suppose, in the meantime, it's fallen to $150 per share and you're not bound by it. So how would you cover the short? You would buy, at this point, 100 shares of Apple at this $150 per share price point. Okay. So the cost of covering the short, as we call it, is $15,000. Okay, you would cover the short at a cost basis of $15,000. Okay, and the last thing you would do is that when the short contract expires, you would go to your friend, you would deliver the 100 Apple shares that you borrowed. You deliver the 100 shares of Apple that you borrowed, and the profit to you is the $20,000 minus the 15. You sold it for 20,000 initially when the price was 200. You bought that same position back at 15,000. So the profits from this entire trade is $5,000. Okay. So this is basically how you execute a short in the market. Yeah, sorry.
Can you also borrow from Apple itself, or you have to, right? Can you just borrow from any company themselves?
I mean, most companies don't really like their shares being sold short in the market, to be honest, because in a certain sense, what you're not very optimistic. You're not an investor. You're a price shark, right? You're there betting against the company in the open market. You're betting that the price is going to fall. So most companies won't allow you to just borrow stock from them to short it in the market. You're going to do this all in the secondary market. You're going to go to existing investors of Apple and borrow from them and then take these positions, right? But the problem is, of course, that the upside is limited. So if you think about what the limit on the upside here is, that the price of Apple basically falls to zero. It basically becomes worthless. You cover the short at a price of zero. So theoretically, the maximum profit you could make out of this entire position is $20,000, right? If the price goes to zero, right? That's the theoretical maximum you can make, which is basically 100% return, right? The theoretical maximum is just 100% return on a short position. But if the price, you bet that the price is going to fall and it goes up to 220, now you're in trouble. You have to cover the short at this high price. You're going to lose $2,000 there. But there's theoretically no limit on the downside. The price can continue to just skyrocket. So you short Tesla at $300, 2 weeks later it's at 900, and you have to cover the short at that price. Theoretically, the stock can really rip through, and then the downside is just unlimited. The exposure on the downside is just completely unlimited. Right? You can lose an extraordinary amount of money just completely going broke in this process. So in a certain sense, a short position is not, you want to take calculated short positions for short durations. You really don't want an open-ended short position, right? Right. So in a practical sense, that's how you do short selling. In general, that's how we do short selling, right? So if you allow for, yeah.
I'm just a little confused. When you're the one borrowing the 100 share, you're borrowing money or you're borrowing shares?
You're borrowing physical units of shares. I transfer 100 shares of Apple from my brokerage account to yours, and it's yours to do whatever you want to do with.
And meaning you could what? You could sell them. You could sell them yourself and do whatever you want with them, and then
yeah. So the contract says, I'll give you 100 shares today. You give me back the 100 shares. Generally, there's a premium, because I don't want to just lend it to you risk-free. I say, okay, I'll lend you 100 shares today. 2 months later, I want back 101 shares. So the extra share that I get is the implicit return on the for allowing you to borrow the stock from me, right? So usually the contract is that I get back slightly more than the 100 shares I lent. So that covers my profit.
Okay.
Right.
So generally you would once you short them, you are selling them.
Yeah, well,
you're selling them and then buying them back.
Yeah, well, yeah. I mean, in a certain sense, you can cover the short. Okay, so if you have a lot of capital lying around and the short position, the short call comes through, it's the 30th of this month, you need to deliver the stock tomorrow and the price is higher than what you originally borrowed at. You have two options. One option is to buy back, you just bite the bullet, take the loss, buy it back, cover the short, deliver the shares back. The other thing is to hold the shares as they are on your balance sheet and not cover that position using buying it back. You just use outside capital to, your other capital to buy back and wait for a better position, because you're wrong on the short side of the bet. So it goes up, right? You own the 100 shares. So you can try to ride the wave on the upside because you're wrong on the downside. You can try to do stuff like that. So it doesn't necessarily have to come from the proceeds of the short sale. But in theory, in a very simple case, this is how the transaction is structured. In a simple case, this is how you would execute a short. Right? Make sense? And you can take leverage short positions, right? So you can borrow money and do a lot of things here. But generally, the theoretical limit on the return that you get from a short position is 100%. You can double your money. Basically, you buy at some price, it goes to zero. That's
So
basically
the whole plot of the Big Short is that basically they just kept shorting, and then made a ton of money on it.
So yeah, they were betting that the housing market was a bubble. So they were basically the way they execute the short is a little bit more convoluted, because what they were buying is in insurance contracts, right? So it's not a direct short. You can't directly borrow mortgages and sell them short in the market. That doesn't work. The instrument doesn't lend itself to that activity. But against the probability of default of the CDO, the collateralized debt obligation, you can buy insurance, right? So how you would execute that short is to say, okay, so there is a basket of mortgages. A bunch of different mortgages are put together into what we call a CDO structure, a collateralized debt obligation structure. And then you would go to an insurance company and say, there is a small probability that this instrument will default, will stop making payments. In good times, it'll just take all these mortgage payments and generate cash flows to your investors based on the tranching. But there's a small probability that it doesn't work and that CDO is going to default on its payments, right? So you go to an insurance, on the counterparty is like AIG. The biggest exposure in the entire mess was on AIG, because AIG was a counterparty to a lot of these insurance transactions. So you'd go to AIG and say, I have this instrument, I would like to insure it. AIG would say, okay, what we want is a premium. So it's like any insurance contract. You just keep paying premiums to AIG, and they keep collecting the premiums. As long as this instrument doesn't default, AIG just keeps making money, just keeps collecting premium after premium after premium. And so you just keep paying them. But in case it defaults, the payday is massive. The insurance payment, it's like life insurance. You pay a small premium month after month after month, but if there's a catastrophic event, the life insurance company is on the hook for $1 million, $2 million, whatever is the insurance policy. It needs to pay that amount. That liability becomes real on the balance sheet, right? So that's one way to bet against the housing market, is to buy insurance for default. You buy the default insurance, you buy up these contracts as many as you can, as much as you can. And if this defaults, then the payday is big, right? So there's no direct way to short the CDO because it doesn't trade on the market exchange itself, but you can take an indirect short position by tapping the insurance market.
Insurance, you're tapping the insurance policy or the company itself?
No, you go to AIG, you have a contract with AIG, says that here's a piece of paper, it says that if this instrument defaults, you pay me X amount of money. Till it doesn't default, I give you a premium for giving me the peace of mind that I know that I'm protected on the downside in case of default, right? So AIG is on the hook for all of that. Now AIG would say, okay, so AIG was not just doing the insurance business, they were also directly participating in the CDO market themselves. That's a different whole other story, where one hand didn't know what the other was doing. One arm of AIG was very active in just buying in the CDO market. The other hand was very busy writing insurance contracts against those CDOs. And now you have a double whammy. First, that there's defaults on the CDO side of the business. On the other side, the insurance business is stressed at the same time. Where do you get liquidity from? Right? So AIG was just slammed from every which direction. Investment banks' exposure was in only one direction, right? Because they sold the CDOs, but they insured themselves with AIG on the back end. Right? So anyway, right. So that's basically how the Big Short, the basic investment thesis for how you would execute a short inside these markets is to bet on insurance contracts. If the instrument itself doesn't trade, you can't directly short it the way you describe it. It's not a traditional short. All right. Any questions? Okay. So, well, that basically leads me, if you follow this argument, then you follow what the argument here is, right? So, let me just turn off my email client. Don't keep buzzing. All right. So if you follow this argument around how you do a short sale, basically it's the same thing. If you have a portfolio weight of -18 on the first asset and +19 on the second asset, right? What do you do? All right. So let me go back. So if W1 is negative 18, W2 is 19, how would you actually execute this kind of position, this kind of portfolio selection? Is that you would borrow 18 units of asset one. Okay, you would borrow $18 worth, I should say. Let me not write it as units. So $18 worth of asset one. Okay, so you sell this asset for $18. So you have these $18 from the short sale. You have $1 of your own money. Let me call it that way. That makes sense. So you have $1 of your own. So together you have $19 in your bank account. You take this $19 and go long on asset two. Okay, so you have a short long position. You short one asset and take the proceeds of that short asset and go long on the other asset. It's a kind of using leverage in a certain sense. You borrow one asset, the asset which has a lower expected return, sell that off, use the proceeds of that to lever up, and go long on the second asset which has a higher expected return. Right? So if you think about what the calculation is, that this is how it generates those weights, right? It means when W1 is negative 18, it says go short of about $18 worth on asset one, and W2 being 19, positive 19 means that go long on asset two of $19 worth, right? And the transaction just works out perfectly, right? So if you think about the calculation here as to how you would be doubling your money, remember you have only $1, right? It's only $1. If you have to double your money, you have to make this dollar into $2, right? You have to basically turn the dollar into $2. Okay, so on the long position, if you go long, and if your expectation is right, so you invested $19, the expected return on the second asset is 10%. So, oh boy, okay. I think I'm having Apple Pencil issues, but hopefully that connects. Okay, all right. So if I go long $19 worth on the second asset, I put $19 times the expected return on the second asset, right? So from here I would get $19. The expected return on the second asset is 10%. Right, so this is 19 times 1.1, which is 20.9. This is the payoff from the long position. I get $20 and 90 cents. Right? But I also have a short position that I need to cover. So you need to cover the short. So it will cost you borrowed $18. The cost of the short is basically the expected movement in that asset between when you borrowed and when it would when you buy it back. So this is expected to move by 5%. Right? The expected return on the asset essentially is indicating that that asset price is expected to move by 5% during that period. Right? So if you borrowed $18 worth, when you go to buy it back, we are expecting that it actually be more expensive by 5%. Right? So if you buy this back at buy this position back to cover the short, this is worth what 18 times 0.5, so 18 point. Right. Okay. So if you think about the net proceeds from the sale, net proceeds from this entire position, you earn $20.90 on your long position. You have to pay back $18.90 to cover your short. So $20.90 is the gains from the long position. You cover your short at $18.90. Voila, you have $2 in your pocket. You took your $1 and turned it into $2. This is 100% expected return. Right. And I can generate any return that you want using this kind of situation, right? You want 1,000%, it's possible. Like when people promise in general, in life in general, in financial markets in particular, high expected returns are very easy to promise and to kind of generate in a certain sense. All it needs is a lot of other people's money. You need to be willing to leverage up to crazy amounts. So if you think about what the leverage ratio here is, you took your $1 and borrowed $18 against that $1. For one, we are assuming that you are allowed to do this. You have $1 in your pocket, you go to the bank and say, I want to borrow $18 against this $1. Most people will laugh you out of the bank. But if you have $1 and you tell a nice plausible story, people will let you borrow $10. You can get to some insane levels of leverage. And especially if you are an institutional investor, you can get to some seriously leveraged positions. People will be willing to lend you that kind of money. So you can generate insane expected returns, but the cost of it is going to basically come at a very high leverage, a very high use of these kind of things, right? So in a certain sense, what is the risk here? The risk here is that you're wrong about the expected move in the short position. You're expecting it's going to move by 5%. Suppose it moves by 12%. Your returns are going to really start to climb down very quickly if you're wrong about this. And if you're badly wrong about this, the downside potential is just exponential, right? You can just keep losing money till the cows come home. The price never recovers and the price just keeps going up and up and up. Where do you cover your short? Right? So there is implicit in that is that you're right about this expectation that the second asset is going to move by only 5% at the time that the first asset is moving by 10%. Implicit is that you're right about this, or if you're wrong, you're not too wrong. Okay, if this is the 0.9, if it moves by 9.5%, it's not the end of the world. The return is not as spectacular. You will miss, you might promise doubling your money, you won't get to doubling your money, you'll get pretty close. And especially if you're wrong about this, and if it's actually lower, if it costs lower to cover the short, then the returns are even higher than what you're expecting. Then the expected return on the portfolio can be even more than 100%, right? So in a certain sense, the point of this exercise is to show you that you need only two assets, two risky assets, and the willingness to gamble. You can generate any kind of return that you want in the financial market.
Would this strategy work, like to get positive profits if you thought both returns were going to be negative and you just like shorted the one that was going to be more negative? Would that turn out, that would turn out well?
Yeah. So essentially it comes down to that story, right? As long as, in a certain sense, as long as the return on assets exceeds the cost of borrowing, when we talked about leverage, this was the crucial condition, right? As long as the return on assets that you purchase with the borrowed money exceeds the cost of borrowing, leverage is always going to pay.
So as long as your long position has a greater return than your short position, you'll be fine.
As long as the expected return on the long position is greater, and the bigger that margin is, the better it is. And in this case, we are not even considering a situation where you can actually borrow money. There's no debt in this. This is manufactured debt. If there is no debt, if there's no concept of debt inside a system, this is how I manufacture a debt position using risky assets, right? I could do this same transaction by borrowing $18 from the bank or from my creditor, right? I could execute basically the same strategy by levering up 18-to-1 on my $1 investment and generate the same kind of situation. But this allows us for a case where you don't need any kind of outside credit facility. You can manufacture that leverage naturally, if that's a phrase that you would like to adopt. So this is naturally manufactured leverage. There is no outside credit, none of that. All right. Yeah, so you can play around with this and look at what asset weights you can come up with, right? You want 1,000% return, set that equal to 100, and then it'll give you some crazy weights on that portfolio weights, but it'll work out. Theoretically, the math will work out. All right. Any questions on this? Okay. All right. Okay. So why today's okay. So the part of the story that we didn't talk about so far, it's all rosy pictures, right? The portfolio selection problem basically comes down to, you start in the too risky assets case, you choose a portfolio weights, W1 and W2, in such a way that you maximize the expected return on the portfolio. Seems reasonable. That's the only constraint, right? If you think about, if I write the portfolio selection problem, you choose portfolio weights in such a way that you maximize the expected return on the portfolio. What's missing from this picture? In a certain sense, all we've talked about is the upside, right? You haven't really talked about how much risk you have to be willing to take in order to execute the strategy. Right? How high is the level of risk, and how do we measure this risk, and all of that? We've never talked about this yet. All we've talked about is, okay, on the upside, theoretically, I can take any two risky assets and generate any kind of return I want, as long as I'm able to first do short selling and do unlimited short selling. In a certain sense, there's no constraints on how big my short position can get. So if you don't buy the situation that I'm allowed to borrow $18 against my $1, 100% return, yeah, who's doubling your money anyway? So you want to promise a 20% return, you can get away with a much less leveraged position. So put the numbers in there instead of 1, right? Instead of this being 1, if you set that equal to 0.2, you're going to get less crazy numbers for what the portfolio weight should be. You can do those things, right? But what's life without trade-offs and what's economics without trade-offs? So, we'll go in and boy. Okay. All right, we'll go in and talk about risk. Right, so let's talk about portfolio risk. How do we measure it? How do we analyze it? And what we do, right? So that's what the phrase here comes down to, right? So when we talk about mean variance portfolio analysis, we are talking about the two things. The mean is the expected return, right? This is telling me the expected return. This I like. The variance is telling me the risk, right? In a certain sense, I'm forming portfolios where I have a trade-off between the return and the risk. And those are the only two relevant things that I really concern myself with, right? So at the end of the day, it comes down to how much expected return can I earn and for what level of risk. That's basically my entire portfolio selection problem. Okay. Right, so the second element of this is to talk about portfolio risk. And in general, the way we measure portfolio risk is to use either the variance or the standard deviation. It depends on the formulation. Sometimes we like using variance, sometimes we like using standard deviation. The variance is just written that way, and the standard deviation is just the square root of the variance. Right? So both are reasonable measures. Depending on the model that you're constructing, you might use one measure or the other, but both of them essentially are measuring level of portfolio risk. Okay. Now, in a theoretical sense, it should make complete sense, because I showed you this once in statistics. If you think about the variance, what the variance is doing, you have an expectation on the return for asset 1, right? This is the average return that you're expecting on asset 1. U1 here, this is what you're expecting on average to get from asset 1. any deviation from this expectation. So if I think about how I'm defining risk in an intuitive sense is a deviation from expectation. It's as simple as that. If I expect something and it happens, there's no risk there. If I expect something and that doesn't happen, if there is a variation between what I expect and what happens, the larger that variation is, the more risk I have on my hands. And in general, when we think about risk, we only think about the downside risk. If I expect 10% and it turns out that the asset only returns 6%, something bad happens and it returns 6%. That people intuitively understand as a risk. That's the downside risk. But if you're expecting 10%, if the asset moves up to 14%, that source of variation on the upside is also a measure of risk, because you built your entire model on the basis that it's going to move up by 10%, and if it moves up by 14%, that's a source of risk. Especially if you're a short seller, it's for you, it's a real source of risk, right? The upside risk for the long position is the downside risk for the short position in a certain sense. Okay, so when we think about risk in general in life, it starts from intuitive understanding of risk is the deviation from expectation. And how do we form this? So if you think about how the variance itself is constructed, so if I think about R1 is a random variable. So R1 is a random variable, which is to say it will take multiple different values. So let me call it X1, X2, X3, X4, X5. If it's a continuous variable, there's an infinite number of values R1 can take. There's a probability with which R1 will be any of these values, P1, P2, P3, P4, P5. Okay. Now, based on this, I can find the expected return on the portfolio. Expected return on the portfolio is I is 1 to N, PIXI. It's just a shorthand notation. Right? This is how we found the expected return on the portfolio was W1 times expected return on R1 plus 1 minus W. It's just the weighted average of the probabilities times the payoffs that I get in each of those periods. So this is just a shorthand notation for writing the expected return on the portfolio. So suppose I call this mu1, let's say mu. Right? This is what I'm expecting to happen on average, the mean or the average. Now a deviation is going to tell me how far I am off in each of these states of the world from my expectation, right? If I get X1, the difference between where I end up minus what I expected, this is risk. In a certain sense, a deviation is the pure measurement of risk, right? So if I get X2, this is how far I am from expectation. If I receive X3, this is how far I am from the expectation. X4, this is how I am far from the expectation. X5, this is how how much I have a deviation. Okay. Now, if I add up those things, you know what the problem is. We've seen this. So if I add up the column of deviation to get an aggregate value for the deviation, then it would be what? X1 minus mu1 plus X2 minus mu2 plus X3 minus mu3 plus X4 minus mu4. Mu1 plus X5 minus mu1, sorry. I keep saying mu5. So this is X1 plus X2 plus X3 plus X4 plus X5 minus 5 times mu1, right? If I try to aggregate, if I try to sum all of these, the columns of the deviations, then I'm going to get this sum here. Okay. So the first part of it is okay. So this is X1 plus X2 plus X3 plus X4 plus X5 minus 5 times, what is mu1? Mu1 is the average, right? So the mu1 is the average of these 5 numbers. and all of these cancel with all of these, and that sum of that column is always going to sum to 0. Okay, so if I try to use the deviation as the measure of risk, which is the right interpretation, that any deviation from expectation is what I call risk, this column is always summing to 0. That's the reason why we use the variance formula. So we square these to get to the variance formula. Okay. Any questions before I go further than this on why we use variance as the mathematical representation of risk? What's the intuitive explanation for why variance or makes sense as the mathematical measurement of risk? And the way we are defining risk is a very intuitive way of defining risk. Any deviation from your expectation is risk. All right. Any questions on this? Actually, okay. You know what? Well, let's stop there actually for today, because I won't keep the entire section on portfolio risk together. I don't think I can finish. We have like, I don't know, 8 minutes left. So we'll actually pick it up on Tuesday's class and figure out how to measure portfolio risk and go into doing more analysis from there. But I hope this is exciting stuff, because this is, it only gets better from here, because all of these foundational parts, once they click into place, when you get into the movements around, effects of diversification, or how we create mean efficiency, mean variance efficient portfolios, all of it just makes complete sense. All right. So if there's any questions, I'm happy to take those, but otherwise we'll stop there for today and we'll pick it up again on Tuesday. Okay.
Thank you, Professor.
Thank you, Professor.
Yep. Have a good one.
Good weekend. Thank you, Professor. Have a good one.
Just one question.
Yes.
Is there any way we could see what we got wrong on the midterm?
I replied to your
Oh, you did. Oh, okay.
comment
Thank you very much.
on Canvas. I don't know if you've seen.
Okay. Thank you very much.
Yeah, of course.